One man turned $105 into over $130 billion using a stock-picking method so simple, most people on Wall Street laugh at it. No algorithms, no insider connections, no crypto, no day trading. Warren Buffett bought his first stock at 11 years old, and by the time most people retire, he was already one of the richest humans who ever lived. And here's the thing that should keep you up at night. He's told us exactly how he does it, step by step, in letters, interviews, and annual meetings for over 60 years. Most people just never bother to actually listen. Today, I'm going to walk you through the exact method, the real method, not the watered-down version you see in 30-second clips. Hey, I'm Joe, and this is Joe Invests. This is the channel where we break down how money actually works. No jargon, no gatekeeping, just the stuff I wish someone had told me 10 years ago. If that sounds like your kind of thing, you know what to do. Subscribe button's right there. But first, let's get into how the greatest investor of all time actually picks what to buy. So here's the problem most people run into when they try to invest. They open up a brokerage app, they see thousands of stocks, and they have absolutely no framework for deciding which ones are actually worth buying. A 2023 survey from Gallup found that only 56% of Americans own any stock at all. And among those who do, a study from J.P. Morgan Asset Management found that the average individual investor earned just 3.6% per year over the 20 years ending in 2022. 3.6%, that's it. Meanwhile, the S&P 500 returned 9.6% annually over the same period. And Warren Buffett's company, Berkshire Hathaway, averaged roughly 19.8% per year from 1965 to 2023. Let me put that in real dollars so it actually hits you. If you invested $10,000 in the S&P 500 in 1965, you'd have around $3.3 million by the end of 2023. Incredible, right? But if you put that same $10,000 into Berkshire Hathaway, you'd have over $370 million. Same starting amount, same number of years, wildly different outcomes. And this isn't some hypothetical. Buffett's track record is audited, public, and documented in every single Berkshire Hathaway annual report since 1965. You can go read them yourself. They're free on Berkshire's website. So the gap between what most investors earn and what's actually possible is enormous. And that gap exists for a very specific reason. Most people pick stocks based on hype, based on what's trending on social media, based on what their coworker mentioned at lunch, based on a chart that some guy on Reddit drew with crayons. Buffett does something completely different. And what he does is surprisingly boring. So why do most investors underperform so badly while Buffett keeps winning decade after decade? It comes down to psychology. And I mean that literally. There's real academic research on this. The first mechanism is something called herd behavior. Professor Robert Shiller at Yale, who won the Nobel Prize in Economics in 2013, showed that asset prices are heavily driven by social contagion. People buy because other people are buying. They sell because other people are selling. It's not rational, it's emotional. Buffett has a famous quote for this: "Be fearful when others are greedy, and greedy when others are fearful." That's not just a cute saying, it's a direct rejection of herd behavior. The second mechanism is loss aversion. Daniel Kahneman and Amos Tversky, two of the most important behavioral economists in history, demonstrated in their 1979 paper on prospect theory that people feel the pain of losing money roughly 2 to 2.5 times more intensely than the pleasure of gaining the same amount. What does that mean in practice? It means when a stock drops 20%, most people panic and sell, even if nothing about the company has actually changed. Buffett does the opposite. When Coca-Cola's stock dropped nearly 30% in 1998 during the Asian financial crisis, Buffett didn't sell a single share. He held, because his method isn't based on what the stock price is doing today, it's based on what the business is worth over decades. The third mechanism is overconfidence bias. Professor Terrance Odean at UC Berkeley published a landmark study in 1999 called "Do Investors Trade Too Much?" And the answer, resoundingly, was yes. He found that the more frequently individual investors traded, the worse their returns. The most active traders in his study underperformed the market by 6.5 percentage points per year. Buffett has held some of his positions for 30, 40, even 50 plus years. His favorite holding period, in his own words, is forever. And the fourth mechanism, maybe the most important one, is what Charlie Munger, Buffett's late business partner, called the Lollapalooza effect. It's when multiple psychological biases stack on top of each other and create catastrophic decision-making. You see a stock going up, so herd behavior kicks in. You buy at the top, then it drops and loss aversion takes over. You sell at the bottom. Then overconfidence tells you the next pick will be different. This cycle, buy high, sell low, repeat, is why the average investor earns 3.6% while the market gives 9.6%. Buffett avoids all of this, not because he's superhuman, but because he has a system, a checklist, a repeatable method that removes emotion from the equation. And that method is what we're going to break down right now. All right, here's where we get practical. I've studied Buffett's letters, his interviews, the books written about him, especially The Warren Buffett Way by Robert Hagstrom and The Intelligent Investor by Benjamin Graham, which Buffett calls the best book on investing ever written. And I've distilled his stock picking method into 5 clear steps. Let me walk you through each one. Step 1. Understand the business. Buffett calls this the circle of competence. If you can't explain what a company does and how it makes money in 2 or 3 sentences, you shouldn't buy it. Period. He famously avoided tech stocks for decades, not because he thought they were bad, but because he didn't understand the underlying business well enough to predict where they'd be in 10 or 20 years. He said, risk comes from not knowing what you're doing. So before you even look at a stock price, ask yourself, do I genuinely understand this company? Step 2. Look for a durable competitive advantage. Buffett calls this the moat. Just like a castle has a moat to keep invaders out, a great business has something that keeps competitors from stealing its customers. This could be a powerful brand, think Coca-Cola or Apple. It could be a cost advantage, like Geico offering cheaper insurance because they sell direct to consumers. It could be switching costs, like how painful it is to move all your data off of Microsoft products. Or it could be a network effect, like how Visa becomes more valuable as more merchants and cardholders join. Buffett has said, the most important thing in evaluating a business is figuring out how big the moat is. Here's a specific example. When Buffett bought See's Candies in 1972 for $25 million, people thought he overpaid. But See's had a brand moat. Customers in California were emotionally attached to See's chocolate. They'd pay a premium for it. By 2019, See's had generated over $2 billion in pre-tax earnings for Berkshire, from a $25 million investment. Step 3. Evaluate the management. Buffett wants leaders who are honest, competent, and think like owners, not just hired managers collecting a paycheck. He looks for CEOs who allocate capital wisely, meaning they invest the company's money in ways that actually generate good returns. He avoids companies where management is overpaying themselves, doing unnecessary acquisitions, or prioritizing short-term stock price over long-term value. In his 1989 letter, Buffett wrote, "When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact." In other words, even great leaders can't save a terrible business. Step 4. Determine the intrinsic value. This is the math part. But don't worry, the concept is simple. Intrinsic value means, what is this business actually worth based on the cash it will generate in the future? Not what the stock market says it's worth today, but what a rational buyer would pay for the entire company if they could own it forever. Buffett uses a method called discounted cash flow analysis. You estimate how much free cash the company will produce over the next 10, 20, 30 years, and then you discount those future dollars back to today's value because a dollar today is worth more than a dollar 10 years from now. You don't need to be a math wizard here. The key insight is this. Buffett only buys when the stock price is significantly below what he calculates the business is worth. Benjamin Graham called this the margin of safety. If you think a company is worth $100 per share, you don't buy at 98. You wait until it's selling for 60 or 70. That gap is your cushion against being wrong. Step 5. Be patient and wait for the right pitch. Buffett uses a baseball analogy that I love. He says investing is like being a batter with no called strikes. Pitches are flying at you every day. Stocks, opportunities, hot tips. But unlike baseball, you don't have to swing. You can stand there and watch 1,000 pitches go by. You only swing when you get a fat pitch right down the middle. Buffett has said there have been entire years where he didn't find a single company worth buying. And he was perfectly fine with that, because one great investment at the right price can be worth more than 100 mediocre ones. In 2016, Buffett finally made his move into Apple, eventually investing over $35 billion. By 2023, that position was worth over $170 billion. One investment. Because he waited for a business he understood, with a massive moat, great management, and a price that made sense. Now here's the beautiful thing about this 5-step method. You don't need to be Warren Buffett to use it. You just need to slow down, do your homework, and resist the urge to chase whatever's hot right now. So let's bring it all together. In Act 1, we looked at the hard data. The average investor earns 3.6% a year. The market returns 9.6%. And Buffett has averaged nearly 20% for almost 60 years. The gap is real, and it's massive. In Act 2, we explored why that gap exists. Herd behavior, loss aversion, overconfidence, the Lollapalooza effect. Our brains are literally wired to make bad investment decisions. And the research from Kahneman, Tversky, Shiller, and Odean proves it. In Act 3, we walked through Buffett's 5-step method. Understand the business, find the moat, evaluate management, calculate intrinsic value with a margin of safety, and be patient enough to wait for the right pitch. None of this is complicated, but it is hard. Because the hardest part of investing isn't learning the method, it's controlling your own emotions long enough to actually follow it. Buffett didn't become the greatest investor of all time because he had a secret formula. He became the greatest because he had the discipline to stick with a simple formula, while everyone else was chasing the next shiny thing. You know, there's a moment in a 2020 Berkshire annual meeting where a shareholder asked Buffett, "Why don't more people just copy what you do?" And Buffett smiled and said, "Because nobody wants to get rich slow." That one sentence says everything. The whole world is trying to find shortcuts, option strategies, meme stocks, leveraged ETFs. And there's nothing wrong with learning about all that stuff. But if you want a proven, battle-tested approach that has generated more wealth than any other strategy in the history of markets, it's the one we just talked about. Start simple. Pick businesses you understand. Look for the moat. Study the management. Make sure the price is right. And then, be patient. The money will follow. It always has. If this video helped you think about investing differently, do me a favor and hit that subscribe button. I make videos like this every week, breaking down how money really works in a way that actually makes sense. I'm Joe, this is Joe Invests, and I'll see you in the next one.